In the next 20 minutes, I'm going to tell you something that most financial advisors and Wall Street hope you never figure out. I want to start with a number, $3.35 million. That's what Gloria has in her investment accounts today. And here's what makes that remarkable. It isn't remarkable because Gloria is extraordinary. It's remarkable because she started with $343,000 ordinary savings built over a career, and 18 years later, 10 times over. Now, I know what you must be thinking. Great story, probably not me. But stay with me for the next 20 minutes because before this episode is over, I'm going to show you the 3 myths the financial industry has built its entire business model on. Myths that are quietly costing you wealth you'll never get back. I'm going to show you how much you trust them and exactly why the advisor sitting across the table from you right now is likely operating from inside a system that mathematically limits what your money can do. And then I'm going to tell you what to do about it. I've been doing this for 40 years. I've seen stagflation. I've seen crashes. I've seen the dot-com bubble inflate and explode. I sat across from clients who lost jobs, went through divorces, faced health crises, and I've watched some of them sail through the storms because they had built enough and others struggles. Others struggled because they were told the safe plan was enough. It wasn't. It wasn't. Gloria, on the other hand, 343,000, 18 years, 3.35 million. It wasn't that she was lucky. It's not because she avoided the layoffs, but 18 years later, she made a different decision about her money. 18 years ago, she made a different decision about her money. Her wealth hadn't become the plan. Gloria got laid off. And most of the people that she worked with were also laid off. They got 6 months severance, but they're still getting rejection letters when they apply. And most of the people are still unemployed. But let me say this. We've seen this movie before. I want to take you back to the early 1990s. I had a client who was a travel agent. And at the time, travel agents were everywhere. There was one on almost every street corner, half a dozen in every shopping mall. It was a real profession with real expertise. These were people who knew the airline codes. They knew the hotel connections, the routing tricks that got you where you needed to go at the best price. And one day I asked my client, the travel agent, I said, "How do you think the internet's going to affect your business?" And he looked at me like I'd asked something ridiculous. He said, "Frankly, travel planning is complicated. It needs a human specialist." And he wasn't wrong about the complexity. He was completely wrong about who would handle it. Within a decade of that conversation, most travel agents were gone. Not because they were bad at their jobs, not because clients stopped valuing the service, but because the value they provided became available another way. Faster, cheaper, accessible at any hour from anywhere. And you know what happened, the internet. I'm telling you this story because we're watching the same movie over again. Except this time, the profession in the crosshairs isn't travel agents. Microsoft, one of the largest technology companies on earth, has identified the financial advisor as one of the roles that AI will eliminate or substantially transform. And I've been in this industry for 40 years. I believe they're right. Now, before you tune out, especially if you're an advisor listening to this, hear me out. Because I don't think all advisors disappear. I think the ones who are doing something genuinely irreplaceable will be fine. Just as there are travel agents who specialize in what they do, there are still travel agents that exist today, and they're very good at what they do. Those who are irreplaceable will be fine. The ones that are running on a model that AI can replicate cheaply, tirelessly, and at scale are already running out of time. So let me show you exactly what I mean. Ask most financial advisors what their value proposition is, and you'll hear some version of the same four things. They listen, they remember you, they hold your hand when the market drops, and they build you a plan. Whether you're talking about a financial advisor or whether you're talking about a do-it-yourself, it's the same four things. So let's go through each one. Your advisor knows your birthday, and I'm talking about advisors, but maybe they know your kid's birthday. AI will know your birthday, your children's birthdays, your grandchildren's birthdays. It'll know your health history, your tax picture, your spending patterns, your estate planning needs, and it will act on all of those proactively without being asked and without ever forgetting. When the market drops, and they will drop, advisors say they're steady the nerves. They call, they talk to clients back from panic, and that matters. But AI agents can already do this. They're available at 3 a.m. They're never rattled by their own fear about their own portfolio. They never project. In Japan right now, artificial intelligence companions are already serving as patient, present, and endlessly available partners who never argue, always listen, and always give you good advice. Their capability will be in your financial app within the next few years. 3, AI can prepare a comprehensive financial plan, can process more information in a second than a human advisor can in a month. It can optimize a tax return. It can monitor spending. It can flag estate planning issues. It can remind you to even take your medication, all as part of the same integrated service relationship. No scheduler, no assistance, no waiting for a quarterly or annual review. And 4, here's the one that matters the most. For a standard diversified approach, the balanced, allocated, index-weighted portfolio that the vast majority of advisors built for the vast majority of clients, AI will construct it, manage it with greater consistency and lower cost than any human can. The average client of a traditional financial advisor earns just over 5% a year, compounded. AI will deliver that reliably for almost nothing. Now, as I say this, none of this is a criticism of individual advisors, no more than it was a criticism of travel agents. Most advisors are talented, hardworking people who genuinely care about their clients. The problem isn't the people, it's the model. And when the model becomes replicable by a machine at a fraction of the cost, the model loses. So the question isn't whether AI will transform financial advice. It will. The question, the one you should be asking your own situation right now is this: what is the human in your financial life actually for? So let me talk. Whether you have an advisor or not, let me talk about the 3 myths that are costing you real wealth. And I want to talk about the 3 ideas that have become so embedded in conventional financial planning and in the market today that most people treat them as facts. Fact is, they're not facts. They're assumptions, and they're costing people real money. Now, I want to be careful here because diversification isn't bad. What I'm saying is that it's been sold to clients as the responsible, prudent, sensible approach. And in doing so, the industry is quietly hidden what diversification actually costs you. And here's the math. A broadly diversified portfolio, a mix of stocks, bonds, bond funds, annuities, maybe some alternatives, is weighted toward assets that by design produce low returns. The safety is real, but so is the ceiling. You can't build significant wealth inside a structure that's designed to smooth out every bump because the bumps are where the returns come from. The risk of never getting ahead is a risk too. It just doesn't show up in a risk tolerance questionnaire. Second myth, the one I feel most strongly about, because the myth that has the most power over investor behavior, is that volatility is dangerous. Volatility is price fluctuation. That's it. It's not a loss. The portfolio going down 20% in a given year is not the same as losing 20% of your money, unless, of course, you sell. And the industry has spent decades training clients to treat those two things as identical, because a frightened client is a client who stays in the safe, diversified portfolio that yields low returns. Permanent loss of capital, that's the real danger. Own a business that goes to zero. Owning a bond from a company or a municipality that defaults, that's a danger. That's what careful stock selection is designed to prevent. Volatility, the fluctuation in price of a fundamentally sound business, is not only survivable, it's actually an opportunity. The third myth, and here's where I'll invoke some names you'll recognize. Warren Buffett has said that diversification is protection against ignorance. Let me say that again. Warren Buffett said that diversification is protection against ignorance. Peter Lynch built his entire career finding 10-baggers, stocks that multiply 10 times in value. Benjamin Graham, the father of value investing, built the intellectual framework that both of them stand on. These are not fringe figures. They're the most respected wealth builders in the history of modern finance. And everyone has said clearly, explicitly, repeatedly, that concentration is the right business of real wealth and how it's built. We've been taught to forget that. The conventional advisory model depends on us forgetting it. So let me talk about what I actually do. Not in vague terms, but specifically. I do not do asset allocation. I build concentrated portfolios around a limited number of high conviction positions. Companies I believe that have the potential to become 10-baggers. Stocks that can multiply 10 times in value over a 5 to 10 year period. And for each position, I require a specific discipline. Twice the upside is downside over that time horizon. If I can't see a credible path to twice the gain versus the potential loss, I don't own it. That filter doesn't eliminate volatility. Nothing does. But it gives every position a rational reason to be in the portfolio. Now, how do I find those companies? Not in the way you'd expect. In an era when everyone assumes superior investing comes from algorithms, AI-driven screens, proprietary data feeds, quantitative models, I find tomorrow's 10-baggers by reading. I read newspapers and magazines and books that describe how the world is actually changing at a human level, and how it's changing in demographics and lifestyles and technology. And finding those before those changes show up in any financial data. And here's why that works. Screens finds what the market already knows. If a trend is visible in a stock screener, it's already priced in. But a magazine article about a demographic shift or a book about a change in how a generation is living, that describes something that's becoming true. And the financial data catches up months or years later I want to own the businesses before the data catches up. There's two types of companies that I look for. The first is classic Benjamin Graham. So cash on the balance sheet greater than the market cap with a positive cash flow, of course. In the 40 years of doing this, I found exactly two that qualified. They're rare. But in an extended period of stagflation, which I believe we may be entering, they may become less rare. I'm watching for them. But 2 in 40 years, very rare. The second type is companies positioned to benefit from changes in demographics, lifestyles, and technology. Not the obvious ones. Everyone owns those already. I'm looking for companies 2 or 3 steps behind the headline, where the change is real, but the market hasn't priced it in yet. The framework I use to do this, to find these companies, build these portfolios, and manage them through the situations that life throws at clients, it's what I call the Watershed Wealth Process. It's built on 4 pillars. The foundation is Benjamin Graham and Warren Buffett, the most credible lineage in value investing. It's not speculation, it's a disciplined practice of a proven tradition. The hunting ground is real-world change, observed through broad reading and deep thinking, not screens that everyone else is running simultaneously. And incidentally, very, very few professional money managers, over 95%, never achieved the returns I achieved. The discipline is twice the upside is downside filter over a 5 to 10 year horizon. Concrete, rational, unemotional. In the experience of 40 years, I've seen stagflation before. I've seen what happens to conventionally diversified portfolios in extended inflationary periods and recessionary periods. That pattern recognition, that's not a credential. It cannot be replicated and it cannot be downloaded. It's destructive. I want to come back to Gloria. Gloria is a real person. The numbers I gave you at the start of this episode are real. $343,000. 18 years, $3.35 million. When her bank laid her off after 30 years, after 6 months severance ran out, after outplacement counselors helped polish a resume that no one seems to want, Gloria didn't need the job market to have mercy on her. She had built something that couldn't be laid off. Her wealth had become the plan. And here's what I really want you to hear. Gloria wasn't the only one. Sandra, Christine, Frank, Herman, Alma, Ron, Ruth, Evie, and there's a dozen more that I haven't listed. I've told you these stories of Sandra, Christine, Frank, Herman, Alma, Ron, Ruth, and Evie. I could tell you more. But every single one of those stories has something in common. At least a tenfold increase in their portfolio after the last 12 to 18 years. Some saw more than tenfold because they've been with me longer than 18 years. These aren't abstract statistics. They're people. People who can now absorb a layoff like Gloria. They can absorb a health crisis, a divorce, a market correction. Not because those things stop happening to them, but because they built enough that those things could not define them, could not derail them, could not take away what they built. That's what I mean when I talk about being equipped, not just to survive situations, but thrive through them. The situations are coming. They always come. The job loss, the inflation, the unexpected medical bill, the market that drops 40%. The question is not whether those things will happen. The question is whether you'll have enough to absorb them without being changed by them. Gloria does. So does Sandra and Frank and Alma and Evie. I want to end with a question. One question, one conversation. If you've been investing 12 to 18 years, putting money away, following your advisor's plan, or doing it yourself, doing what you were told was the responsible thing, has your portfolio grown tenfold? If the answer is yes, wonderful. You're doing something right. Keep doing it. If the answer is no, and for most people listening, it won't be a yes, I want you to ask yourself one follow-up question. What would your life look like if it had? It's not a hypothetical designed to make you feel bad about what you have. It's a genuine question about what is still possible. Because if you're in your 40s or your 50s or 60s or even 70s or 80s, there's still time, not unlimited time, but time. And the decisions you make in the next few years about how your money is positioned will have consequences that last the rest of your life. Almost every advisor in this industry offers a second opinion. No obligation, no sales pitch. You've probably heard that. But what I want to point out is that you've already given yourself a second opinion. You just need to look at your own numbers. Your portfolio has already told you what it thinks. If what it told you isn't enough, if it has told you that you haven't grown tenfold in the last 18 years, and if what you heard today makes you think there might be a different way, I'd like to talk. One conversation, no pitch, no pressure. Just an honest look at what the Watershed Wealth Process might mean for where you are now and where you want to be. My name is Mike Adams. This has been the Watershed Wealth Podcast. Thanks for staying the full 20 minutes. And if this resonated with you, share it with someone whose financial future you care about. And if you're ready for that conversation, the link is in the description below. Take care of yourselves and take care of your future. And let me ask if there are any questions you have. Oops. I thought we were going to.
There we go. I was able to find my way back. Now, just give me 1 second. There's a little bit of noise in the background here. I'm just going to mute out while that noise is out.
And I think, Chris, you're breaking up. Chris is on vacation in the Bahamas. So anyway, he's having.
All right. Hey, thanks, Mike. Um, yes, on vacation in the Bahamas, but still wanting to be here with you today. So, Mike, that was super insightful. Somebody asks, how did Gloria find you when she, and they weren't positive on that was the name, but how did Gloria find you? When did she start working with you?
So Gloria's mother told her about me because Gloria worked with someone who was one of my clients. Gloria's mother didn't have any money, worked at a kind of dead-end job, but she told Gloria about me. And Gloria was a saver. I mean, in 30 years, she saved she saved a fair amount of money. She saved in 12 years, she put away 343,000. And she would add to that 600,000 from a 401k when she got laid off. So Gloria had saved money. But the 343,000 turned into a couple million, turned into 2.7 million, in fact, and added the 600,000 when she got laid off in August of last year. She's done well, but she was a saver to begin with. That's how Gloria found me. Gloria called me.
Thanks, Mike. So I will comment. I will let you know that in the chat, I have just placed a couple of links for everybody that's here. Now, I'm putting these in the webinar chat. If you happen to be watching this on a replay, I'm going to have those links down in the description. But you can find the replay of all of our broadcasts on our YouTube channel. You'll find that link in the chat. And if you're watching this on the replay, congratulations, you're already on the YouTube channel. What we ask is that when you watch these videos, if you got some value from them, first, if you could subscribe to the channel, that would mean the world to us because it would help us surface for more people who could use this advice. And second, if you go to the YouTube channel, check out some of the shorter videos. All of those names that Mike mentioned, we're producing small vignette videos, case studies, if you will, video case studies of those clients that Mike has worked with, and you can hear their full stories in those quick 2 to 3 minute videos. So as you go to the channel, which on YouTube is known as About Money Radio, you'll find all of the rebroadcasts of our Thursday episodes, as well as those short case study vignettes about the people that Mike has worked with. Mike, another question. Oh, and then, pardon me, there's also two other links that you'll find in the webinar chat. One is Mike's direct email address. If you send Mike an email, you can get on his calendar that way. And I will include that in the description of this video as well. You can also email him and he will send you his latest ebook called The Commodity Trap, which has been a very popular request among people. So you can get that by emailing Mike at adamsfinancialconcepts.com. And then finally, the third link in the chat is Mike's direct calendar. So you can click on that if you want to book some time with him. Mike, somebody asks how you came up with the system that you described for picking the assets that you pick.
So I started out as a stockbroker, a stock jockey back in 1986. And I read a lot. As I read articles about how to make money, there were hundreds, maybe thousands of articles, of books, of flyers, of things that talked about people making money. I can remember going to trade shows later on where you had things where they said people made money doing this. They didn't say how much money. They just said people made money. And I believe that. I believe that most financial advisors make money for their clients. It's not if you make money, it's how much you make. And at the same time, my son was in the 8th grade and they asked me to do a class on investing. And I thought, now's the time to really take, and I was really new in the business at the time. I'd been a stockbroker for a year maybe. And I figured, okay, I have to math, and with an undergraduate degree in math, I want to define what I believe is a great investor. A great investor that can produce 25% or 20% per year compounded return over 25 years. That would turn $10,000 into $1 million. I didn't know if I was going to find one person, if I found no one, or if I was going to find 1,000 people that were able to easily do that. But I wanted to do that to see if I could find people who did that and study what they do. I lived in France for a year and a half, and I looked at the Impressionists, and the Impressionists actually studied other people. Artists studied other people. They studied with mentors. And so I went looking in the literature for my mentors, and I found actually there were some people that could actually produce a 20% return for 25 years. Warren Buffett, Roe Price, John Templeton, Pete, Philip Fisher, and for 17 years, Peter Lynch. And with that, I looked at what they would do and I studied what they did. And that's where I started my whole process and beginning to define it 20% for 25 years. And I have not achieved that in my time, but they were all during good times, during that long bull market. So I looked at that and I wanted to define things mathematically. And that's where I came up with the idea of twice the upside is downside, of doing concentrated portfolios, which grows out of game theory. And in my reading, I also found the work that had been done on what was the optimum number to reduce risk or to reduce volatility. So that's a long answer to a short question, but maybe
A
that.
great answer. Yeah, that was a great answer. Mike, somebody asks what the first meeting with you looks like.
First meeting is really easy. I just go over what I do, a lot of some of what I just explained. And I also want to know what people expect, what their reward risk is. And I have a question that I always ask when clients meet. And my question, I believe, gives me a better indication of what a client's risk tolerance is than any other questionnaire. I've used questionnaires over the past. I believe this question that I ask really gives me a better feeling for what clients' risk tolerance really is. Because when the market is doing really great, people have a really great risk tolerance. When the market is doing really poorly and down, people have a very small risk tolerance. I want to know what the long-term risk tolerance is. And so I have a question. I'm not going to share the question on this program. I share it specifically with individual clients, and I don't want people to know what that question is. But if you contact me and you're really interested, I will ask you that question.
I know that question, and I think that's a great question to ask in the first meeting. Totally agree. Mike, I don't have any other questions queued up in the chat, but I will remind everyone that the link for the YouTube channel is in the chat. Mike's email address is in the chat, as well as his calendar link, which I know Mike is happy to have people hop on his calendar for a no obligation meeting. Mike, I have a question. What is the topic that you've got lined up for next Thursday?
Let me add one more thing. These are the disclaimers. I love these disclaimers. I think they really describe what we do in addition. But what's coming up next week? Actually, this was something that needed to be changed. This is not going to be the topic coming next week. We have a new chairman of the Federal Reserve. We have a history of changes of the Federal Reserve. I want to talk about some of the things that are going to happen under our new Fed chairman. Things that may happen, may not happen, but how the scenario going forward is going to change. I can tell you that I do not believe it's going to be all positive. I'll leave you with that thought.
Mike, I'm looking forward to that one. Mike, let me just thank everybody that's been here with us for the broadcast today, whether you were here live or you watched this in the replay. We're grateful for the time that you spent with us today, and we'll look forward to seeing you on future broadcasts. And Mike, with that, you get the final word.
Have a very good week and a very good time. The market, I'll leave you with a couple thoughts where the market is. Remember we had tariffs and the tariffs got reduced. Remember that 90% of the tariffs, that increase in price on goods was passed on to consumers. Now that we no longer have tariffs, have you seen prices reduced? Anyway, with that, we're going to talk more about that next week and the week after. So join me those times. And if you're listening to this on the podcast or want to see the podcast, go subscribe. And with that, I'm going to close off and say, have a very good week and weekend.